You can support this podcast for $3 a month at patreon.com/copytradersclub, or find me on eToro, username Gavin Macaulay, and add me to a watch list for future content. Thanks for listening. Copytraders Club, where you can learn how to make better decisions and more money copy trading. I'm Gavin Macaulay, my name and username on eToro. Today we welcome back one of the big names on eToro, a French guy who seems to be on a tour of Europe's premier cities. Here we go. Season 2, episode 27 of the Copytraders Club podcast, and as always, my aim as an eToro enthusiast is to demystify this new and uncharted world of copy trading, understand what are the pitfalls and best practices, and how ultimately to succeed as a copy trader. In chats like today's, the aim is to answer all your questions about this popular investor, and reveal more about them than anywhere else, so you can assess whether they might suit you. In this episode, we catch up again with Hugo Manenti, who was the hottest thing last time we spoke, and who, like many, has had a bit of a sobering time since, both in terms of his portfolio and copier numbers. But he's still near the top of the eToro tree. And here he is. Hugo, encore une fois, bienvenue au Copytraders Club.
Merci Gavin, c'est un plaisir d'être de retour.
Okay, and because you were here before, that means you don't have to clear security this time. You've already got your pass, so shall we proceed straight through to the lounge?
Of course, looking forward to it.
Okay, Hugo, you know the form. You just take it easy. Can I get you a little drink?
Yeah, that'll be Cuba Libre, please.
Okay, we'll have 2 of those, please, Yasmin. Okay, so Hugo, you've been on before. You're the second ever returning guest after J Nemesis. So, quite an honor.
Quite an honor indeed.
The second ever returning guest, I should say, as a solo performer. I think you were back, weren't you, for a round table previously?
Yeah, had a little conversation with yourself, Andrew and Gasper.
That's right.
Yeah.
Well, a lot has changed since you were last on in September of last year. And I think we'll follow what we did last time with Jay, which is run through a number of things we talked about last time and see what the updates are and what has changed, what hasn't, if you're fine with that. One thing that's changed that I'm aware of, just because of the little chat we had before we started recording, is your whereabouts. Tell us about that.
Indeed, I decided to leave my dear Barcelona a few months ago and move to sunny Lisbon. Not too much of a change culturally and weather-wise, but I'm looking forward to that next step. Lisbon is a little more quiet, a little smaller versus Barcelona, and I'm looking forward to those 2 things. I'm probably getting older. I think it's what's happening.
Yeah, what was behind the change? Was it just time to move on? How long had you been in Barcelona?
Yeah, time to move on. I mean, I spent 3 years and a half in Barcelona, and most of that was during COVID. So it hasn't been the most exciting time of my life, I would say. And I felt like I kind of needed a fresh start, something more positive to look forward to. And on top of that, I think we saw tourism coming back in full swing in Barcelona. Not the sort of best kind of tourism, and I think that also participated in my decision. So I kind of like took that opportunity that I have obviously now that I'm full-time eToro, to sort of live wherever I want. And yeah, try something new.
Yeah, we talked about tourism coming back to Barcelona in your first appearance, which I listened to in preparation for this. And so you're in Lisbon, awesome city, great fun. I don't know if I'm going to be able to respond to this, but what part of town are you in Lisbon?
I'm in Madragoa at the moment, which is just above Santos. So just a tiny bit outside of the center, but very close to it.
Is that like on elevated ground in the old town?
Slightly elevated indeed, yes.
Well, there's a lot of hills in Lisbon. You're going to be, if you're walking around, you're going to be getting plenty of cardio.
Yeah, I'm already fitter. I had 2 bouts of COVID this year, which kind of tired me a little bit physically, and it's getting back now, thanks to the hills.
Okay. Muito bom. You're going to be working on your Portuguese, no doubt.
Yes. Not just now, but yes, eventually. I've had not a hard time, but I've had to obviously learn Spanish. Well, I did speak Spanish, but I guess improve my Spanish and then learned a bit of Catalan to go by in Barcelona and make friends as well. And I feel like I just got good at Catalan and don't fancy too much learning a new language again.
And do you know other PIs that live in Lisbon?
Yes, George is here. And there's a bit of a Portuguese crew, guys that I met at the Web Summit. So that's going to be interesting as well. And there's obviously, did you have him in your show, Pedro?
Pedro Nunez?
Yes.
No, not yet.
Well, very interesting person that I'm also looking forward to knowing better now that I'm in Lisbon. Pedro is a very interesting person. He used to be a policeman and then sort of undercover investigator. I mean, there's a really interesting story. Very different profile from anyone else you'll have on eToro. A super nice guy. I definitely recommend him for your show.
Okay, well, I will reach out to him, and you can also do the same and say, you should go on this podcast.
Yeah.
Because in all honesty, my forward schedule is very empty.
All right.
I just realized today, and I'm thinking, who else am I going to talk to? Because quite a few of the people that I've reached out to don't seem terribly keen. Even the guys that are doing well. It's fair enough. I can understand people who've had a horror year not wanting to be on. Although things have turned around recently. But anyway, that gets us into talking a bit more about the markets. So let's talk about what else has changed since you were here last. Last time you were on, you were talking about building up your Chinese holdings to perhaps 8 to 10% because of all the long-term tailwinds and the amount of value in the Chinese market, which was the prevailing view at the time. Now I see you have nothing in China. You own Taiwan Semiconductors. That's part of China, isn't it, Taiwan?
Well, depend which side of the border you sit.
Well, there are a number of pretty obvious reasons why your short-term view on China may have changed. I wonder, is the same true of your long-term view? Perhaps you could spell each out to us. China short-term and long-term.
Absolutely. I think that the short-term view has changed a bit more negatively. But more importantly, I think it's the long-term view that has changed pretty dramatically as far as I'm concerned. And I actually exited my Chinese holdings not too long after we spoke last time. I think in the short term, it looks quite bad. I mean, you have the real estate crisis, you have people stopping to pay their mortgages, you have a sort of stop and go policy when it comes to COVID lockdowns, tensions with the West, which are not helping the economy either. And so that creates a lot of unpredictability, a lot of instability in China, which could kind of resolve either way. I could see a scenario where Chinese growth continues to be very sluggish. The real estate crisis doesn't really improve. There's still COVID going on in some parts of the country, and so things don't really get better. I could also see a scenario where things would get better in the short term. If COVID kind of goes away, if things with Taiwan and the US calm down a little bit and the Chinese government starts providing a lot more support to the economy, you could have a sort of like reflationary boom, right? Where the economy reopens, the country reopens, you have strong fiscal and monetary support, and you have a bit of a strong period of growth in the near term. So what happens eventually depends a lot on what political decisions the Chinese government is going to make, right? Do we keep that sort of zero COVID policy and do we keep fighting the US and Taiwan, or do we sort of decide to tone it down, reopen the economy and provide support? And I have no edge there. I have no idea what they're going to do in the short term. I think longer term, I'm a lot more negative than I was about a year ago. I feel like China is sort of reaching an inflection point, or has probably reached it already, where the demography of the country starts being a sort of headwind rather than a tailwind, where you have an aging population, which is not growing anymore and is about to decrease. You have a country which is a huge energy importer, which is going to be an issue. And on top of it, you have the war between Russia and Ukraine, where, China's pretty clearly taken the side of Russia and is continuing a sort of a path of confrontation with the West. And what does that mean? That means that, the West, which was your largest customer, is kind of going away as a customer, not abruptly, but little by little. So your end market, so China's been growing since 30 years on the strategy of essentially, exporting goods to the West. And that was based on cheap labor, cheap energy, political stability. And all of that is going away. China labor is not cheap anymore. Energy is expensive. The relationship with the West and the political stability is not there anymore. So how do you grow longer term? Technology, it's not quite there yet, China, in terms of technology, getting better, but still very reliant on Western technologies to grow. If they need to do it all alone without copying, it's going to be a lot harder. So I'm kind of like looking at all of that, and I'm wondering whether sort of engine for growth is in China for the longer term, and I just don't really see it. And I see a sort of political and social contract within the country that starts getting challenged a little bit. People not very happy. And the sort of idea between China, the Chinese Communist Party and the Chinese people has been, we sort of leave you alone. We provide you a good standard or improving standard of living. And on the other hand, you population leave us party alone, do whatever we want to do, And I'm not sure that's going to be easy to maintain if the standard of living stops improving. Let's see, they're using definitely nationalism to maintain that, when it comes to the Taiwan crisis. Not sure that's very sustainable. So I think I'm sort of like seeing the sort of energy, the Chinese economy and the country as a whole transition from that sort of 30 years of high growth based on certain factors that are no longer there. And so I'm wondering what's next, and I don't really see it. And if they want a confrontation with the West, I might not be in the consensus, but I see them having a pretty tough time if they choose that path.
Yeah, things have changed seemingly very quickly, haven't they, for Chinese prospects?
They have, right? You've seen them taking political decisions that were a bit unexpected. They've essentially sunk their economy for the sake of zero COVID, which is not something I expected them to do. And they've been, progressively increasing the level of confrontation with the West. Obviously it takes two sides to confront, right? The West has clearly also raised the tone when it comes to China, but I didn't expect really China to be so confrontational with the West, given how much reliance they have on Western technology and the Western markets as an export market. I didn't expect any of those two things to happen. And obviously the war in Ukraine has accelerated all of that dramatically. And I think, yes, for sure, the world is very different than it was back in December of last year. And I think we have to take account of that as investors.
Yeah, so no China in your portfolio in the foreseeable future. But you were never a big China fan, really. It was always quite a limited part of your portfolio. I'd be interested to see what the real China enthusiasts on eToro are doing. Actually, I must look into that. There's a couple I can think of right now, and I haven't checked their portfolios for a while. You would imagine that holding firm isn't going to work out too well for them.
Yeah, I would have my doubts. I mean, I see respectable macro analysts saying that China is about to enter a reflationary phase, right, based on no more COVID and strong fiscal support. It might be the case, but that's short term. I think longer term is a lot more difficult.
And what are they going to do when Monkeypox hits, as Jay would have us think? It's going to be massive.
I mean, you need to watch out for it. Seriously, I'm not sure I'm super scared about it yet. I mean, I'm not, but I think you need to watch out for it for sure. I mean, we've seen what COVID did to our economies, right? And it's definitely not the same thing, but need to be careful.
Okay, so what else has changed? Well, your assets under copy last time we talked, which was September of last year, so 11 months ago. Do you recall what your AUC was back then?
Not exactly sure, but it must have been somewhere between $16 and $18 million.
Oh, higher.
Higher than this, maybe closer to 20.
Higher.
Oh, even higher. Okay, 24.
Yeah, it was almost 25, I think.
Okay, yeah, that was the peak.
Today it's somewhere around half that, I guess. I mean, I don't know what your latest numbers are, but it's in that region.
It's half that, yeah.
So cut in half, as has been your salary.
Indeed.
When we spoke last time, you were on the cusp of quitting your job to go full-time on eToro.
Yeah.
You're still on a very healthy salary, of course.
Yes.
And it's all on the public record, so not too vulgar to discuss, I hope.
Absolutely not.
Somewhere in the region of 230,000 before taxes and expenses.
Yes, it's around that. Yeah.
So the question is, do you ever worry about having quit your job when you see how dramatically the numbers can change?
Not really. That was kind of part of the contingency plan. I mean, when I quit my job, I kind of thought, okay, what if we get a big drawdown in the market and I lose half of my assets? That's kind of what happened. I mean, in fairness, I thought that it would be worse. I thought if I'd get a sort of like 30% or 40% drawdown, I'd lose more than half of my assets. And people have actually stuck with me, which has been quite nice to see. I would say the smaller copiers have left. The larger ones have stayed. That's a nice thing to see, I think, a nice proof of support. But yeah, that was always part of the risk. I'm not worried, because if for some reason eToro would, was to go away, disappear, go bankrupt, or whatever, or if I was really bad at investing and I just kept going down, or whatever could happen. I mean, I can still get a job. I'm not going to end up being homeless or whatever. And actually, the financial industry it's quite healthy at the moment. I mean, I'm getting job offers literally every day in my inbox. Right? I'm ignoring them, but there are alternatives to eToro for me if things were to not work out.
Do you think the risk of things not working out is limited because you're a big enough PI that you've built up a financial cushion to handle any fluctuations in the market?
Correct. I mean, I don't really have a luxury kind of lifestyle, I'm getting paid, $20,000 per month, more or less. I mean, I don't know, my expenses are not a quarter of that, much less than that. I live like a normal person. So my assets could get halved again and I would still earn a lot more than I spend. Mm-hmm. And on top of that, of course, I've been saving all of my life. So I have a nice cushion in terms of my assets, which are all pretty much in the market anyway. What I worry about is not really my ability to maintain my lifestyle, is more my ability to get back up in terms of my investment performance, because I have a lot of assets in the market. My copiers have a lot of assets in the market, and that's kind of what I worry about. My own lifestyle, there's no danger to that. I live quite frugally.
Yeah, I think we should be more concerned about, say, elite PIs who are on a quarter of what you were.
Yeah.
They're the ones more likely to have sleepless nights because, going from 100K to 50K or 75 to 30 or 40 to 20 is a lot more impactful.
Yes. And it kind of like makes you reconsider whether you can afford to live on your eToro salary or not. For black stars like me, I think it's much less of a concern, unless you're a very high spender.
Well, 20,000 a month should keep you in plenty of Pastel de nata.
Yeah, around 25,000 of them. I could probably feed the whole neighborhood.
Can we move on, Hugo, to a couple of questions that I saw in your feed recently?
Of course.
One question that keeps arising on your feed is, why are you always closing and then immediately reopening positions? And one question said, explain why we are reopening the closed position just a few seconds apart. Today you took the same action with Digital Turbine with nearly the same invested amount. And then I saw in one of your posts you provided a series of answers to FAQs. Let me read your answer. There's a tight balancing act that I need to do between taking advantage of volatility and managing the risk score. There's quite a bit of fine-tuning to do. And due to how the risk score works, sometimes the only way to do that is to close a losing trade in a stock in order to replace it with a larger one. Look at how we increased Digital Turbine and how it benefited us lately. So, if I understand correctly, you're saying you'll close a position which is in red, maybe deep red, and then reopen it with perhaps a larger amount so that that position no longer shows as a deep red position. You're resetting your entry price for the risk score. The risk score measures volatility, and you're turning a high volatility position into a low volatility position. Is my understanding correct?
Yes, partially. I mean, there's a lot of reasons to close and open positions that seem to be the same, but are not exactly. When I did that this year, it was mostly because I wanted to increase my investment in some higher volatility assets without blowing up the risk score. And when you have a position of, say, $1,000 in a high volatility assets, which has had a drawdown of 50% and is now only worth $500, the risk score is based on $1,000, not on the 500. And that caused a bit of an issue because then in terms of risk, that asset, which has become a smaller part of the portfolio, is still accounted for as a very large part of your portfolio in terms of the risk calculation. And so that creates a false impression of your portfolio. Beyond the risk calculation, the issue is that the new copiers get their copy to open based on the percentage invested rather than the percentage actual. And so whenever someone new copies your portfolio or someone decides to add fund to their copy, they're going to copy a portfolio which is not yours. There's a problem of desync that we all know about.
So that's a rebalancing issue. That's nothing to do with the risk score.
Exactly. So when I do close and open positions again, the main reason is to rebalance. Also close some smaller positions that I had before adding funds, which are almost impossible to copy unless you add $1,000 to the copy, right? It's like legacy small positions. And then, obviously to increase the position that I have in some assets without blowing up the risk score. And so it serves sort of all of those purposes at the same time. And it's a bit delicate because people hate me to close positions at a loss, but the reality is that it doesn't matter, right? Because if I reopen that same position with a higher dollar amount, the loss is a paper loss. It's not an actual loss. The position is still there. But some people, have a hard time sort of understanding the rationale and accepting it because it shows a sort of a loss on their copy that has materialized, even if it's still a paper loss.
Also, about 3 months ago, I saw quite a few posts on your feed questioning your whereabouts, copiers crying out for an update. Ultimately, you replied, "Hi all, apologies, but the environment has been so volatile that it's been hard to put thoughts together." So what was going on there? How hard is it to keep communications going when times are tough? Is there any excuse for it?
I don't think so. The issue is when you speak, you want to have something to say, right? A proper analysis to provide to people. It's like when there's a new war starting, which has unpredictable effects on the economy, on the whole investing environment. What can I say? You sort of like, sometimes you need a bit of time to sort of gather your thoughts, see what's actually happening, and then provide an informed view. Putting out a post that says, "Don't worry, everything is fine," for the sake of it, I think is a bit, it's not very genuine, like, I don't know that everything is fine. And I don't want to pretend that everything is fine if I'm not sure that everything is fine. Yeah, there are copiers who kind of like want reassurance regularly. They would like me to post every week to say that everything is okay, everything is under control. I just don't think that's a good thing to do on my side. I think I want to speak when I have something to say. I don't want to sort of be a bit of a nanny for people. I don't think that's helpful. I think people need to accept that sometimes there is uncertainty and to just let it play out. If people get used to me saying everything is fine all the time, I mean, what am I saying? What kind of value am I actually adding? So that's kind of what happened, I think, in February, March, particularly, which was not sure what's going on. I mean, kind of like a lot of uncertainty. Markets are up and down, up and down, up and down. And do I need to say something every time markets are down? I don't think it's a good, it's a bit Pavlovian, right? You kind of sort of like, people then are going to expect me to say everything is fine every time the market goes down. It's like, no, just market is down. That's just how it is. It happens. And I don't need to say something every time the market goes down.
Well, that's an interesting view of management of copier psychology.
Yes, I want copiers to be able to stand on their 2 feet in a way. I don't want them to need me to say everything is fine every time there's a bit of volatility. I think that they need to understand that it's part of the market, that it's kind of like part of the life of investing, and that they don't need me to say something in order for them to make a decision or make no decision on their copy.
Okay, Hugo, before we get on with more investing talk, last time we spoke, you were telling us how you love to go to gigs. We talked about Interpol and one or two other bands, I think. Have you been to any since COVID ended? What was the most recent live performance you saw?
I've been to a festival. Yeah, I just went to Primavera Sound in Lisbon, which was early June. Gigs were all cancelled until, I think, April or May because of COVID. So nothing, and then the festival happened, and that was 3 full days of music, just amazing.
And who was playing at that?
We had Tame Impala, we had Nick Cave, we had Fontaines DC, who are neighbors of yours, based in Dublin. Very exciting kind of new band, brilliant young people.
I don't know them. I'll have to look them up.
And then we had the Idols, who were very excited to not be in the UK during the Queen's Jubilee, and made us sing profanities at the Queen and the monarchy in general. How shocking.
Sure you enjoyed that.
As a French Republican, indeed, I usually don't have much sympathy for monarchies in general.
Okay, let's get back to business then. So, one thing that has struck me since we last spoke is that you're much more of a macro guy than I think I appreciated first time around. And you seem to be something of a contrarian when it comes to the economic outlook. You're certainly not as bearish as many of the voices out there. So I guess that will inform your views on a couple of specific stocks we'll talk about later. But let's talk a little bit about macro. I saw you use the term in one of your recent posts, Fed pivot. You seem to be, or at least you were, expecting the Fed to pivot sooner rather than later. Question number one, are you still expecting that, or has that changed?
I think my view is a bit more nuanced versus when I wrote that post.
I'm sorry, let me interject. What does Fed pivot mean? Can you explain that while giving this answer?
Of course. So the Fed has been tightening its monetary policy for a while now, at least since the beginning of the year. Doing quantitative tightening, which is essentially selling assets to the markets rather than buying them from the market, and obviously hiking interest rates. So what a pivot means is essentially that the Fed will stop hiking rates and selling assets to the market, and instead will go back to the policy of the last 10 years, essentially, which is to keep interest rates low and to buy assets from the market. So why would the Fed pivot? For essentially two potential reasons, which might happen at the same time. One would be inflation to come down dramatically towards their target of 2%. And the second one would be the economy crashing under the weight of, geopolitical conflicts, obviously Fed monetary policy, lack of fiscal support, over-indebtedness, whatever. And so the assumption is that if the economy came crashing down while inflation was still high, the Fed would probably pivot to supporting the economy rather than fighting inflation in terms of their priorities. So that's what people mean by Fed pivot. I sort of expected it to happen sooner rather than later for two reasons. I think I think inflation is going to trend down pretty sharply in the back half of the year. That's the main reason. I think the economy is doing pretty okay, and is going to continue to do pretty okay. And I don't think the state of the economy will necessarily warrant a pivot from the Fed anytime soon. But my thinking around the inflation is that, you can see the price of commodities going down pretty materially since 3, 4, 5 months, right? You've seen oil, you've seen agricultural goods, you've seen all types of metals going down pretty materially. And that's going to push inflation down over the next few months. And I think the second factor is a sort of easing of supply chain constraints, right? We're seeing freight costs dropping at the moment. I mean, it's been the case for a few months. Or you're reading tidbits from many companies that are saying, the situation around supply chains is improving, right? I have it in my portfolio, in housing, have it in electrical supplies. You're hearing it from several industries, that things are starting to improve. There's a long way towards, back to normality, but the trend is right. So I think under the effect of commodities price going down and supply chain troubles easing, CPI on inflation should trend down pretty substantially over the next few months, meaning that the Fed won't need to be too aggressive in terms of their hiking anymore. And so that's why I expect Fed to pivot, And what I mean pivot is not necessarily going back to easing and to supporting the economy with, massive inflows of liquidity, but just more like, stopping essentially the tightening and going to a more neutral stance.
Do you think that the recent apparently healthy employment numbers and an apparently strong stock market of late will knock any talk of a pivot on the head, and the Fed will use it as an opportunity to keep raising interest rates so they have some ammunition to lower them when they really need to stimulate things?
Quite possibly. A sort of like fast deteriorating economy would indeed be a cause for the Fed to slow down on hiking. Not that the signals from the employment market are strong, then they don't have any reason to slow down the rate hikes. That being said, they're also the symptom of an economy which is much more resilient than people had anticipated just a couple of months ago, right? I mean, the economy is slowing down pretty clearly, but employment is still very strong, credit quality of households is still strong. People are spending money. And so I think I'm kind of seeing it the other way around, which is that the sort of runway for a softish landing is getting longer because the economy is so resilient. it means that the Fed can keep hiking for longer in order for inflation to start coming down before the economy crashes, right? The prevailing view for the last 6 months has been the economy is going to crash because of the Fed, and inflation will still be high, and we're a bit in and the Fed is in a bit of a pickle. Now, if the economy doesn't come down crashing, that means that you have more time, essentially, for the Fed to keep hiking, to take inflation down before the economy eventually crashes, if it ever does. So I see it as a sort of like the strong data is an extension of the runway for the Fed, and it provides them with more time to bring inflation down.
Well, among the strong data that you quote there are the employment numbers, which come from the Bureau of Labor Statistics, BLS, or possibly BALS for short. Now, their report is in advance of the midterm elections. So to many, these numbers are massaged to fit the government narrative. It actually looks like more people are working multiple jobs in real life. Hardly the sign of a thriving economy. And I was listening to something the other day that was talking about the other jobs data that many point to as the household survey, where real people's information is gathered. And that paints a very different picture, one of an overall trend of declining employment. So, I mean, I'm sort of getting into an area that's not my area of expertise, and you could run rings around me, but is there a danger that the employment numbers aren't really to be relied on? This is a bear market rally. Everyone's desperate not to miss the bottom. And this is just the calm or the happy days before things really take a turn for the worse.
I wouldn't think so unless something, new and material happens, whatever that is. I think people are realizing that the economy is just more resilient than they expected. Of course, there's a lot of nuance in the data. It's not all rosy. There's a squeeze on real earnings, right? It's pretty clear because of inflation. And so indeed, more people are having to work 2 jobs, or, I would say lower income households are having to cut spending in certain areas. But then the sort of like top 80% of households are doing just pretty fine, I mean, there's a squeeze on real earnings, but at the same time, there's only 3.5% unemployment, which is kind of the lowest ever almost. So what does it mean? It means that the economy is sort of running so hot that inflation is eating into people's income. But it's a phenomenon that you often see post-recessions, where the economy restarts very fast. And then sort of after 1 year or two, there's a period of adjustment where the economy is running so hot that inflation starts eating into earnings. And so you sort of like need to cool down a little bit. And you call that early cycle readjustment. And you saw that after the great financial crisis. And I think you saw that after the Second World War as well. And I think that's what we're seeing again, sort of like early cycle readjustment, where the economy runs a bit too hot, gets ahead of itself, and so real wages decrease a little bit because of inflation, and then you sort of like need to tame down inflation to have a more sort of like lower but healthier kind of growth. I think that's what's happening. I may be wrong, but that's kind of how I view it. And I think that the data is very mixed. It's hard to be 100% bearish or 100% bullish. You see a lot of conflicting data, right? You see PMI surveys which show a weakening of the economy, but then it kind of depends on the sector, it depends on the area. The employment is strong, customer spending is strong. It's a bit of a mixed bag of data, and I think it's consistent with a sort of like just readjustment of the economy rather than a full-blown crisis.
Like, I don't know who's right or wrong, but you're definitely more positive than a lot of the information and discussions that I've been consuming of late, I have to say.
Yeah.
Do you feel like you're a bit of a contrarian in this issue?
I know I have 2 biases in general. I tend to be a bit too optimistic, but I think history has proven that you need to be optimistic to make money in the markets as a whole, because they tend to go up over time. So it's a bias that I know, but I think it's fine. And then the second bias that I have is I indeed tend to be a little bit contrarian, which can be an issue because obviously the market went against me in the first half of the year, and I kind of accepted it. But that means losing money in the short term. But can also be a good thing because you sort of like spot opportunities where most people don't. And you don't just, it's easy to listen to the bearish narrative and sort of like get married to it and then don't realize when things are actually not as bad as you thought, or like ignore the positive data points. It's very easy, and everyone's doing that. And I think you need always to be a little bit contrarian because the power of narratives has become so strong, right? Investing at the moment, it's all about narratives. And you need to be a bit contrarian to spot the sort of weakness of those narratives, which will, eventually unwind them. And so those are two biases that I know and accept and sort of try to use to my advantage in a way.
Do you copy?
Do you copy?
Do you copy?
Do you copy?
Copytraders Club.
Copytraders Club.
Do you copy?
Do you copy?
Do you copy?
Do you copy?
Copytraders Club.
Copytraders Club.
Okay, well, let's move from the macro to the more specific. I should have said from the macro to the micron, because that's what we're going to talk about now. Is your thesis still intact for Micron? We talked about that last time you were on. Gross margins doing nicely, plenty of cash. Started paying dividends even, and talking about aggressive share buybacks.
Yeah.
You're still bullish on Micron? That's one of the themes in your portfolio, isn't it? Microchips.
It is. Yeah, in addition to Micron, I have AMD, Taiwan Semiconductors, and Applied Materials. So that's four chip companies in like sort of different areas or different parts of the value chain. Yes, I mean, I think so far the thesis is proven right on Micron. We've seen that Micron was doing very well when times were good for the industry. You've seen much higher margins, higher sales, a good return of capital to shareholders in the form of dividends and share buybacks. But essentially, my whole thesis around Micron and the semiconductor industry as a whole is that the drivers of growth are a lot more secular than they are cyclical. And that the competitive situation within the industry is such that in addition to the secular drivers of growth, the sector is going to be much more resilient than it was in the past, much less cyclical, and that should warrant higher valuation multiples from investors. But obviously, the only way you can see if that thesis is correct is through poor times. When everything is fine, then obviously the sector is fine. When things are a bit rough, that's where you can see whether the thesis that the sector is more resilient is going to be, proven or disproven. And so that's what we're seeing at the moment. And we've seen, for instance, for AMD that I have in the portfolio, there's an economic slowdown. You look at the AMD numbers, no slowdown at all. It's just a fantastic company, and there's no impact. And so I think on AMD, the thesis so far is completely right. On Micron, you're starting to see a slowdown in the numbers, which was to be expected. I mean, memory is more cyclical than CPUs and GPUs, but still they're getting towards fairly strong margin, still profitability, decent capital returns to shareholders. So whereas in the past, a slowdown in the industry would mean burning cash, making losses, and not returning anything to shareholders, so far in the present, a downturn in the industry means that you're still profitable, you still have decent margin, and you can still afford to pay a dividend and buy back shares. So if it doesn't get worse than this for Micron, I think the sort of investment thesis around it is completely proven. And in the future, we should get higher valuation multiples for that business. So far, so good. Let's see how the next few quarters go, but I'm pretty confident about it. And as I said, I might sound lunatic, but I think the sort of like drawdown and sort of rougher time for the sector is a great opportunity for investors like me to buy shares on the cheap and get the thesis proven by the facts.
Yeah, so the business lows are getting higher, if you like, for Micron. Now, Micron is a US-based company, the only US-based company in the oligopoly of the memory chip market. Question I wanted to ask you is, harking back to what we were talking about China earlier, if China and America are growing further apart and America is going to be looking for more local solutions to their supply chain issues in a less globalized world. Is that all great news for Micron?
Yeah, I think it means a bit of short-term pain because you might lose a bit of your market when it comes to China, for instance. But it's a longer-term gain for sure. I mean, you've seen with the CHIPS Act in the US that they're massively subsidizing the production of semiconductors within the US. And Micron is the only US-based provider of memory chips. And so as such, there will be a huge beneficiary from that, the new law. But beyond the law, I think there'll be a big beneficiary from that trend of, as you say, reshoring supply chains, working on a sort of like technology leadership and self-sufficiency. I think that they're in a great spot there. It might not show in the numbers just next year, but over a period of 3, 4, 5 years, then I'm expecting good things, definitely.
Yeah, okay. So everybody likes to talk about this oligopoly in the memory chip market.
Yeah.
There's basically 3 companies, Micron, Samsung, and SK Hynix. Now, in terms of the DRAM market, Micron has 22.3% market share. Samsung has 42.3%. And in the NAND market, Samsung has 33.1% to Micron's 10%.
Hmm.
Why do people not talk about Samsung more?
The problem with Samsung is that they're a bit of a jack of all trades. They do a lot of things, right? They're a foundry for other types of chips. Then they also design and produce their own memory chips. They're obviously a very large electronics conglomerate. So they have their fingers in too many pots, I think.
Well, that's the next paragraph I have written here in my notes is, I was thinking it might be because they're a conglomerate with fingers in so many pies. That the semiconductor pie is only one of many things they're doing. Yeah. But it turns out semiconductors is almost half their business. And Samsung, I mean, I haven't looked at them in any great detail, but loads of cash, no debt, involved in a number of growth segments, great ROE and ROI figures, low PE, paying a good dividend. I wonder whether that would be a good thing for people to look at if they want to diversify out of the US. Samsung are listed in London, but Korean, obviously. This is one of your areas, so tell me why I shouldn't be looking at Samsung as such a positive opportunity.
I'm not gonna try to tell you off. I used to own Samsung. I did in 2020, I think, for about 6 months, and then I decided to go all in on Micron. It's a good company. The valuation is very reasonable, and indeed, it's a good way to diversify away from the US. They're a bit more insulated from that sort of geopolitical issues. So there's really nothing wrong with Samsung. What I like about Micron is essentially, I think they have better IP around DRAM in particular. And I think their end markets are a little bit more attractive. For instance, they're very present in data centers and automobile. And I think there's a lot of growth coming from automobile in the next 5 to 10 years, because obviously electric vehicles, there's just electronics everywhere, chips everywhere. And now you have sort of like Tesla putting kind of mini TVs in their cars. We're adding so much technology in the cars that they require a lot more memory than in the past, but it's exponential, right? And so I think with the IP that they have and the end markets where they specialize, I think Micron is in a bit of a better position versus Samsung, just focusing on DRAM, right, on memory. But obviously, if you buy Samsung, you have exposure to memory, you have exposure to the foundry business, which is based neither in Taiwan nor in the US. So it's a good diversification for sure. And their electronics business, which is, pretty decent. I mean, the second best behind Apple, I would say. And again, is neither US nor Chinese, talking about Huawei in particular, which is no longer politically acceptable anywhere. So it's definitely, they're definitely in an interesting spot. Yeah, they do too many things for my liking. And you have also the sort of internal Korean politics. The former chairman is in prison or was in prison, have those tax issues. it's a big conglomerate with a lot of infighting. Don't like all of that too much. But I'm not gonna tell anyone off. Looking deeper into Samsung is definitely an interesting company for the times.
Is there anything else you'd like to say, Hugo, which kind of explains what you're all about, or how you're feeling about the market these days, or where you think you define yourself as an investor in today's market?
Something that I would like to kind of make stand out possibly is the fact that I think it's kind of where my sweet spot is. It's like sectors that are considered to be very cyclical because of how they've behaved in the past. And that I see from a sort of contrarian perspective as becoming a lot less cyclical and a lot more secular in terms of their growth. And that's essentially what we discussed around the semiconductor industry, but it also applies to other parts of the portfolio, like home building, for instance, that I think we probably talked about last time, which has always been a very cyclical sector, but because of demographics, is becoming a lot more secular in terms of its growth drivers. That's also when you look at Wesco, my largest company in portfolio, it's like supply of electrical material. Used to be very cyclical, low margin, but now because we're building so many, solar farms, solar equipment for houses, EV charging stations, data centers, all of those secular themes of growth, are driving the sort of distribution of electrical equipment sector towards a lot more stable and stronger growth profile. So I think that's where I sort of like my investing sweet spot really resides, is like spotting those transformations in certain sectors of the industry before other people do.
Last time you were on, Hugo, you talked about how eToro reached out to you just after you joined the PI program. They said they were interested in you and they felt there was a lack of financial professionals on the PI program, which is why they wanted to promote you. That's very interesting to me. I understand why they would want to promote that profile of person. Gives the program a bit more gravitas. However, recently one such PI that fits that mold has perhaps turned that theory on its head a little bit. Are you aware of the Trades with James story that just unfolded?
I'm aware that it came to the program with a bit of a bang and quite a bit of promotion, I would say, from the platform, and then left in silence as far as I can see. I don't know any of the intricacies, but it's quite disappointing to see.
It's certainly disappointing for his copiers. And I think it shows the dangers of eToro promoting financial professionals, particularly those with conflicts of interest, like ongoing roles, selling investing courses, for example. So James Helliwell, as you said, a very confident arrival on the scene. He made a YouTube video declaring he was beginning a crusade that would result in him being the number one PI on eToro. Bit of a smooth operator, and he was welcomed with open arms by eToro, heavily promoted on Editor's Choice. And I believe he even did a workshop of some sort that everyone got a notification on.
Yeah, I did.
He started interviewing PIs on YouTube too, but of course, he only wanted to talk to the most popular ones, right from the off, only black stars, which might make you question who was being promoted by those videos. Unlike Copytraders Club, of course, which has given a platform to PIs across the popularity spectrum.
Yeah.
So I think it'd be quite interesting for us to discuss this issue. Should eToro seek to eliminate the ability of PIs to sell courses, or to give access to their private investor groups, which are paid for? On the one hand, it's a clear conflict of interest, and copiers, I always think from the copiers' point of view, can't be sure if they're being viewed only as copiers or as potential customers for another product other than eToro. What are your thoughts on that?
Yeah, I definitely don't like eToro being used as a sort of stepping stone towards selling other products to copiers. And if you want to sell trading courses, you'd better have strong qualifications for that and a strong track record. I think I have like new issues with the sort of ethics of that, selling trading courses. I mean, I don't want to say it's inherently bad, because you can sell courses to people which are actually good courses and like sort of improve the level of understanding of the economy of the market and so on. But I don't like the sort of, the behavior of using your popularity as a leverage towards selling other products in general. I think you can find a lot of fine trading courses on the internet for free. You can have a lot of educational material on the internet for free. And so I would personally never sell any kind of courses or any kind of service to any of my copiers. I think the only way I'd ever do it is for free. So yeah, I'm totally in support of providing education and information to copiers, but against doing it with the aim of, making a profit out of them. And there was another famous Frenchman who kind of did the same thing, didn't he? Tried to use the eToro platform for the sake of selling his own trading courses or crypto get-rich-quick kind of schemes. And thankfully kind of got booted off the platform, but way too late in my view.
But he was due to become a billionaire, so presumably with crypto, he's done well.
Yeah. Well, luckily for him, crypto has been doing better recently, but I'm sure it's just a matter of time before it kind of blows up.
Yeah, the other side of the argument, I suppose, is that if eToro adopt like a really strict policy in this area, it could put off potential PIs from becoming PIs, people who work in the industry. I always look at things from the copier's perspective. As a copier, I'd not want to be viewed by my PIs as a potential customer for something outside of eToro. As a copier, I'm already doing the PI a favor, or at least I'm upholding my end of the bargain by copying them, and I expect the PI service in return. End of story. If I'm a copier who wants to learn how to invest for myself, I learn from those PIs who offer it as part of their service. Maybe that means open source on YouTube, or maybe to copiers exclusively somehow, but doesn't involve any payment, no private groups. Yeah, I understand that eToro want to attract people from the industry onto the platform, and it's understandable that people might want to join and then see how it goes, prove themselves on eToro before letting go of everything else first. So there's going to be a period of where they're keeping various balls in the air, you know what I mean?
Yeah.
So I guess that's eToro's perspective, right?
Yeah. I just don't think it's a very good idea to promote someone with 6 months of experience on the platform, essentially no track record. I mean, they did it with me, so it's like, who am I to complain about it? But it just doesn't feel right. Someone who's been untested, unproven, being promoted so much on the platform.
Well, they have to promote people who are doing well. And most of the people who are doing really well until very recently were people with short-term records, because all the old school are significantly down in 2022.
I mean, that's what happens when you invest for the long term, Okay, you had COVID in 2020, which was a very specific event, which, some people saw in advance and hedged against. I think this year is a lot more difficult because there's no specific event which you could have forecasts and hedged against, at the beginning of this year. Yes, valuations were high, but they can be and remain high for a long time. And so, what would be, as of the 1st of January of 2022, what would be your reason to go short the market? There's no specific reason. So if you're a long-term investor, I don't think there was any specific reason to really hedge the portfolio materially. And so almost all of us had significant drawdowns. That's just how it is, I think.
Try telling that to copiers with all their hindsight bias.
I know everyone knows better with hindsight, but I try to say I'm open and frank about it. It's like yes, with the benefit of hindsight, I should have hedged, but if I were today in the same position as 6 months ago, knowing what I knew 6 months ago, I would make the same choices pretty much. Well, I've made mistakes that I know now, things that I could have done better. So with the benefits of hindsight and experience, I could do better, but it's difficult. And never forget that hedging is a way of losing money over the short term if you do it too much. I see copiers piling into new APIs whose track record essentially has been to be short the market this year or long oil stocks. And, good for those people. Does that make them, great long-term investors? I don't know. They've been right once. Copying someone because they've been right once with expectation that they're going to be right always is not right. Those people that have done very well early this year, once more, good for them and well done. But it's like past performance is not an accurate predictor of future performance. It's always what we say, right? And those people that have done well this year, at some point in the future, will do less well. Usually what you see in finance is the people who did well recently are going to usually do less well in the near future, right? Because mean reversal and all of that. And so you kind of see copiers jumping from the hot PIs onto the next hot PIs and always exiting at a loss because of mean reversal, essentially. And it's difficult.
That's the greatest problem with copy trading and why most copiers don't do that well. So it's something the body of copiers has to learn, that they're investors too, and that's buying high, selling low.
Exactly. Exactly.
Let's move on to the issue of adding funds. I see you added a significant amount to your portfolio recently, 60%. How did you go about that?
So the way I did it, I gave a couple of weeks notice, if I remember correctly. And essentially, I didn't change my portfolio. Like the new funds were invested exactly the same way as the old funds. And so for a copier who didn't add funds, there was essentially nothing to do. I think that was the most important thing for me. I didn't want to bother copiers with my adding funds. So get the option to do nothing.
You didn't close and reopen?
I didn't. I sort of essentially doubled the amount of investment into every stock. So if you're a copier who had no willingness or no possibility to invest more funds, essentially that copier wouldn't have opened any of the new trades.
So you increase the portfolio size by adding to all positions in proportion according to the value column. Now that always causes confusion among copiers every time someone wants to add money, which is unsurprising really because there are many moving parts. Can we talk about a few issues that I saw discussed on your feed between you and your copiers in this area?
Of course, yeah.
One is people saying this will cause massive desync because different acquisition prices and many of the transactions will be below the minimum. 2 points to discuss there. One, different acquisition prices. What relevance has that got to desync?
None. You need to try to be a bit pedagogic about it. What matters is the percentages that you have in each stock of the portfolio, and if they're equal to mine, whatever your entry price, then if my portfolio moves up by 1%, then the copier's portfolio will move up by 1% as well. That's all that matters. Entry prices are entirely irrelevant.
Yeah, nothing changes for the copier as far as entry prices are concerned. Their entry prices were the prices that they paid when they copied or subsequently to that when you entered new positions.
Yes.
The second part of that concern was whether transactions would then be below the minimum. Now, I think the copier was confused that maybe he was under an obligation to also add 60% of his previous copy amount or something, which might have been less than the minimum. But can you clarify something for me? Because I'm not even sure about this, Hugo.
Yes.
What if, before you added funds, you have position sizes that are just above the minimum size in your portfolio? Okay? And then you add 60% and you only buy on top of the existing portfolio according to the value column, then those original positions are going to be reduced in proportion, potentially to below the minimum amount. What would happen in that case?
That means that I used to be copyable with around $230, and that's no longer the case. I've actually put it on my bio. The new minimum to copy me is around $500. It's a bit less than $500, but for safety, I I put $500.
Okay, because when we spoke last time, it was also $500. So I was wondering if I'd misunderstood that.
Was it? It used to be $330. I used to put a little more just to have a margin of safety. If I said 500 at the time, then that was wrong of me.
What I want to know is, my theory is correct, that existing positions will be effectively diluted, right?
Yeah. So I closed the tiny ones, and now the closest one is copyable with $500.
Okay.
So essentially, the minimum copy size has increased as a result.
Yes. So copyable for the minimum amount of $500 would mean the smallest trade size in your portfolio would be 0.2%. Okay.
Yes.
And I went through your portfolio, and that's the case. The smallest is 0.23%, which is one Bitcoin trade.
Yep.
Okay. So that's something to keep an eye on then when you're adding funds. If you're going to do it the way you did it, it's important to see to what extent your smallest positions are going to be diluted. Interesting. Why did you do it that way rather than closing and reopening? Because that's the way most people do it. Close everything, reopen everything again. What's the benefit of doing it your way?
I only pay the spread fee on the funds that I added instead of paying spread fee on the whole portfolio. For existing copiers, that means that they don't have to sacrifice any returns, essentially.
Do you know how much in dollar terms your spread fees were for doing that? Or in percentage terms even? Like how much would it impact copiers? Because copiers often jump up and down about spread fees. But I think if you were to spell it out to them and say, look, this costs you 37 cents or $1.20 or whatever, it'd be a different story.
Yeah, the average is 0.1% of the portfolio, more or less, in terms of spread fees. So that's not really material. But I did it the way you said last time, closing everything and reopening. And I had quite a few complaints, because if your copy size is, say 100K, then 0.5% of 100K is indeed material. So to take into account the sort of criticism, I decided to not close everything. There's also tax issues for some people. If you close a position and then reopen it immediately, which would be the case, you have sort of bread and breakfasting kind of rules. It's a very tiny minority of countries, but essentially if you sell a position at a loss and then you reopen it right away, that loss is not deductible from the CGT tax perspective. In most countries, it still is, but in the very minority of countries, it is no longer. So there's a few copiers who would have lost that by paying more tax than they should, essentially, if I had to close everything down.
Well, it's impossible to please everyone all the time.
It's very difficult. Yes, you have to make compromises, and some people will lose out. And, I try to be honest about it. Some people have lost out, and I explained why I did what I did the way I did it. Some people didn't like it, but I can't please everyone. So I'm just trying to find the way that pleases most people.
Impetus for adding funds solely to take advantage of prices, or were you also getting close to your minimum portfolio amount required to maintain Black Star status?
No, I said I had a significant amount of funds on my bank account first, and then on other trading accounts, which essentially replicate the same strategy. So I had significant funds available, and then significant funds invested in the same manner that I could transfer to eToro. And I think so. I think it made sense to just have everything in the same place first, and to use the sort of like significant amount of cash that I had in my bank account to take advantage of lower prices. So I was not too close to the minimum required, but certainly getting closer. I sort of killed two birds with one stone. So now I have over $100,000 invested in that main account. It's good to show copiers that you have incentive aligned with them, and that you're trying to be proactive in terms of taking advantage of lower prices. And copiers like when you sort of take a stand and say, prices are cheap now, I'm going to add funds. They sort of value that.
And they don't like it if you say, my portfolio amount has just dipped below the minimum, therefore I'm adding funds. And you need to as well.
Yeah.
A couple of PIs have run into some issues with that recently, particularly one who's not too far away from you geographically.
Well, I mean, I sort of understand it. It's your salary, and you don't want to lose your salary on the technicality.
I understand it too, but if you're a Black Star PI and you're earning the big bucks, your portfolio should be way above the minimum, right?
Absolutely, yeah, absolutely.
Like when I become a Black Star, I'm definitely going to have 6 figures in my account.
Of course, of course, yeah. It's a fair comment. I didn't dip below the minimum and didn't come too close, but the issue is, when eToro is your only source of income, which is kind of what eToro asks of you as well, then can you afford to lose that only source of income as a PI? And then that's when the sort of strict requirement to have 50K minimum invested in portfolio is a bit complicated. It's complicated. I think it's a complicated issue for PIs. Like, I don't want to kind of, I said I would want to criticize anyone who sort of like falls below the threshold and then decides to add funds, especially when the markets are very low and they see a good opportunity to add funds, with a big caveat, which is provided that they add fund in a way that is not destructive to copiers, essentially the way I did it.
Well, I'm not criticizing anyone individually, but when you compare the minimum portfolio amount for a Black Star and the salary that a Black Star appears to be getting, I think sometimes when copiers realize the discrepancy between those two numbers, they feel maybe a kind of a slight sense of disbelief that the minimum portfolio amount isn't a higher proportion of salary. You don't think that's justified from the copier's viewpoint?
Yeah, I guess what I need to explain as a PI is that I have a lot more money invested behind my strategy than it's just on my primary account. But the problem is we're getting paid on another account, which then goes straight to our bank account. And so when I was promoted to Black Star PI, I didn't have that many spare funds in my old personal account. So I put kind of everything that I could, which got me a little bit above the threshold. And then I grew my account to a point where I had more safety, right? But the issue is, like, in order to more than meet the minimum amount, you need to add funds at some point, And so when do you do it? Like, you know what I mean? So like I started eToro with 10,000, and then I sort of got promoted to Blue Star. So I put another 20,000, and then I got promoted to Black Star. I had to put another 30, 40,000, all within the space of 6 months. So I wasn't a millionaire. So I put everything I could into the market, and that just got me barely above the minimum. And then indeed, then subsequently, I got paid a very high salary by eToro, but I was never able to put that salary into my main account because that would have been disruptive to copiers. And so that sort of money always stayed in another account. And so the sort of like amount that PIs have in their primary account does not necessarily tell the whole story. I can't say whether everyone does it the way I do. Maybe people get the money from the salaries and just blow it in, whatever, buy expensive cars or whatever they do. I invest it very much entirely back into the market, but I can't do it through my primary account. So it's a bit of a problem that we have. I wish there was a way to add funds to my primary account without disrupting copiers. That would make my life much easier. But I think it's sort of like, I think it explains why some PIs can be paid a lot of money, but are not really able to put it in the main accounts.
Did you go to the PI meetup in London?
I did.
Who did you hang with mostly?
So I have my good mate, Robert Reynolds. I got the opportunity to meet Jay in person for the first time, which was great. I'm still a bit of a fanboy, obviously. And I started at eToro, and he was a top guy, and still is. And I got the opportunity to meet also with Zek, who's also one of the PIs that I rate very, very highly. So that was great. And then some other people that I met in Lisbon at the Web Summit as well. Nice to see. So that was, nice time.
Did you have any official duties that day? Did you have to give a talk on anything? Or
I was hosting a roundtable, which was a sort of free Q&A session where other less experienced PIs could just come to the table and ask me questions. Nothing else. I think the people that spoke and presented were usually either PIs with a few years more of experience on the platform than myself, or PIs who did better this year.
okay, I think that just about does it. Hugo, always a pleasure to chat to you, whether you're in Barcelona or Lisbon or any other fun European capital. Thank you for dropping by the Copytraders Clubhouse.
Well, thank you again for hosting me for the third time now. Wish you all the success that you and your show deserve. Always a pleasure to be here.
Always interesting to chat to Hugo. Time will tell if his optimistic outlook will work, both over the short and long term, and if he can ride this cyclical to secular wave all the way home. I link to his musical recommendations, which I've been enjoying since the recording. Another little bonus listener, because I'm hopelessly devoted to you. That's all from me. See you on Discord and Facebook. Until next time we meet at Copytraders Club, I wish you many happy returns. Obviously, anything you hear in this podcast is for entertainment only, not financial advice. Do your own research. This is just generic chit-chat. We don't know your individual circumstances, etc., and so forth.